Let me tell you about the most expensive mistake parents make when leaving money to their kids. It's not leaving them too much, it's not leaving them too little, it's the way they leave it. Because here's what most people don't realize. The IRS can take up to 40% of your inheritance depending on how you structure it. Or you could legally reduce that to almost nothing. And it gets worse. The method most parents use, just handing everything over when they die, can actually ruin their kids' lives. I'm going to show you 3 completely different ways to leave money to your children, the tax implications of each one, and the real life scenario where a well-meaning parent accidentally created a financial disaster for their daughter. Let's jump in. Hey everyone, welcome back. If you're new here, I break down financial and legal strategies that can save you serious money and protect your family. Today, we're talking about something that affects almost everyone: how to leave money to your kids in the smartest way possible. And I want to be clear up front. Although I'm an attorney, I'm not a CPA. This video is for educational purposes only. It isn't legal nor tax advice, and watching it doesn't create an attorney-client relationship. If you need advice for your specific situation, please contact a qualified estate planning or CPA. Most people think inheritance is simple. You die, your kids get your money. Done. But there are actually 3 main strategies, each with widely different tax consequences, levels of control, and long-term outcomes. Method 1: outright inheritance. This is what most people default to. When you die, your kids inherit your assets directly. The house goes into their name, the bank accounts transfer to them, everything becomes theirs immediately with no strings attached. It's simple, straightforward, and for some families, it works perfectly fine. Here's the process. You name your children as beneficiaries in your will or on your accounts. When you die, after probate or through beneficiary designations, assets transfer to them. They get full control immediately. The tax situation. Federal estate tax. In 2025, the federal estate tax exemption is $13.99 million per person or $27.98 million for a married couple. If your estate is under these amounts, your kids pay 0 federal estate tax. So if you're worth $5 million and you die, your kids inherit that $5 million tax-free at the federal level. That's huge. But here's the catch. This exemption is set to drop to $7 million per person in 2026 unless Congress extends it. So the rules might change. State estate taxes. Here's where it gets tricky. 12 states plus DC have their own estate or inheritance tax. Fortunately, Georgia doesn't. And their exemptions are much lower. Massachusetts, $2 million exemption. Oregon, $1 million. Maryland has both an estate tax and an inheritance tax. So you could be well under the federal exemption, but still owe significant state taxes. Fortunately, as I said, here in Georgia, we mirror the federal estate tax exemption. Capital gains treatment, the step-up basis. This is the secret weapon of outright inheritance, and most people don't even know about it. Let's say you bought a house in 1990 for $100,000. Today, it's worth $600,000. If you sold it while alive, you'd pay capital gains tax on the $500,000 gain. But if your kids inherit it, they get a step up in basis. Their basis becomes $600,000 and the value at your death. If they sell it for $600,000, they pay 0 capital gains tax. This step up applies to almost everything: stocks, real estate, collectibles. It's one of the biggest tax breaks in the entire tax code. The advantages: it's the easiest to set up and understand. No complex structures, no ongoing maintenance. Step up in basis. Your kids get that huge tax break on the appreciated assets. Flexibility. Your kids can do whatever they want with the money immediately. Low cost. No trust administration fees or ongoing legal costs. The disadvantages: no protection from creditors. If your kids get sued or divorced, that inheritance is fair game. It's their asset, so their creditors can go after it. No protection from poor decisions. Remember that 23-year-old I mentioned? Imagine handing them $800,000 with 0 guidance. Some kids, will inherit it wisely. Others will blow it in 2 years, all at once. There's no gradual distribution. They get everything immediately, whether they're ready or not. Substance abuse or disability concerns. If your child struggles with addiction or has special needs, a lump sum can be devastating or disqualify them from benefits. Real life example. Let me tell you about Jennifer. Her father died and left her $400,000 outright. She was 26, recently divorced, and struggling emotionally. Within 6 months, her ex-husband sued for a portion of the inheritance, claiming it should have been marital property. Then a friend convinced her to invest $150,000 in a can't-miss business opportunity that went bankrupt. 2 years later, she had less than $80,000 left. Her father's entire life savings gone. Could a different method have protected her? Absolutely. Method 2, inheritance through trust. Instead of giving assets directly to your kids, you put them in a trust. The trust owns the assets, a trustee manages them, and your children are the beneficiaries. You set the rules, when they get money, how much, under what conditions, and who's in charge. Types of trusts for children. Standard inheritance trust. This is the most common. You create a trust in your will or living trust that activates when you die. An example structure: your daughter receives 1/3 of the trust at age 25, another third at age 30, and the remainder at age 35. Or my son receives $50,000 per year for living expenses, with the trustee having discretion for education, health, or business needs. Option 2, lifetime asset protection trust. This is more sophisticated. The trust continues for your child's entire life. They can access money according to your rules, but the principal stays in the trust. Why would you do this? Maximum creditor protection. If your daughter gets sued, creditors can't touch trust assets because she doesn't technically own them. Option 3, special needs trust. If your child has a disability and receives government benefits like SSI or Medicaid, a direct inheritance could disqualify them. A special needs trust lets you leave them money without affecting their benefits. The trustee can use funds for supplemental needs, vacations, electronics, therapy, whatever improves their quality of life. The tax situation with trusts. Estate taxes. Trusts don't change your estate tax situation. If you were under the exemption, you still are. Step-up basis. Your kids still get the step-up in basis on inheritance assets. The tax break doesn't disappear. Trust income taxes. Here's the catch. Trusts are separate tax entities with their own tax brackets, and trust tax brackets are compressed. In 2025, trusts hit the highest federal tax rates of 37% at just $15,200 of income. An individual doesn't hit that rate until $609,000. This means income generated inside the trust gets taxed heavily. However, when the trust distributes money to beneficiaries, they pay tax at their individual rates. Smart trustees distribute income to beneficiaries in lower tax brackets rather than accumulating it in the trust. The advantages: control from the grave. You decide when and how your kids get money. Not at 18, not all at once, but according to your wisdom. Creditor protection. Properly structured trusts protect assets from lawsuits, divorces, and creditors. Substance abuse protection. If your child struggles with addiction, the trustee can withhold funds or release them only for specific purposes like treatment. Spendthrift protection. Can't trust your kid with money? The trustee manages it for them. Incentive structures. You can build incentives. You get $100,000 when you graduate college. You get matching funds for every dollar you earn. Multi-generational wealth. Trusts can continue for grandchildren, great-grandchildren, creating lasting family wealth. Here in Georgia, trusts may last for up to 360 years. The disadvantages. Cost. Setting up a comprehensive trust will cost thousands. Ongoing administration costs hundreds to thousands per year. Complexity. Trusts require maintenance, trustee management, separate tax returns, and legal compliance. Remember those compressed brackets? If income accumulates in the trust, you're paying heavy taxes. Potential family conflict. Your son might resent having a trustee control his money. This can create tension. Trustee selection stress. You need to choose someone responsible, trustworthy, and willing to serve. That's that's not always easy. Real life example. Let me tell you about Michael. He built a $3 million real estate portfolio. He had 3 kids, one who was financially responsible, one who had a gambling problem, and one who was going through a messy divorce. Michael created 3 separate trusts, each customized for the child's situation. Responsible kid, simple trust, 50% at 30, remainder at 35. Gambling problem kid, lifetime trust with strict distributions only for housing, healthcare, and verified expenses. No lump sums ever. Divorcing kid, all inheritance went into a protected trust. When the divorce finalized, the ex-spouse got nothing from the inheritance because it was never the kid's individual asset. The trust structure cost Michael $8,000 to set up, but it protected $3 million and prevented family disasters. That's an incredible return on investment. Lifetime gifts and other vehicles. Here's a completely different approach. Give money to your kids while you're still alive. Sounds crazy, right? But there are some serious tax advantages to this strategy. Annual gift tax exclusion. In 2025, you can give $18,000 per person per year without any gift tax or reporting requirements. Your spouse can also give $18,000. So if you have 2 kids, you and your spouse can give away $72,000 every year, completely tax-free forever. Do this for 20 years, that's $1.44 million transferred out of your estate with 0 tax consequences. The tax magic of lifetime gifts. When you give assets during your lifetime, you also give away all future appreciation. Let's say you give your son stock worth $50,000 today. Over the next 20 years, that stock rose to $300,000. When you die, that $300,000 is not in your estate. It's completely outside of estate tax calculations. If you had kept it and left it to him at death, the full $300,000 counts against your estate tax exemption. 529 education plans. Here's a hybrid approach. Fund a 529 plan for your kids or grandkids. You can contribute up to $18,000 per year, or you can superfund it with 5 years of contribution at once. That's $90,000 per beneficiary with no gift tax. The money grows tax-free, and distributions for education are tax-free. Plus, it's out of your estate. And here's a little known fact. If your kid doesn't use all the money, you can change the beneficiary to grandkids or other relatives. Roth IRA conversions and gifts. Here's an advanced strategy. Convert some of your traditional IRA to a Roth IRA. Pay the taxes, then leave the Roth to your kids. Why? Because Roth IRAs grow tax-free and distributions are tax-free. Your kids inherit a tax-free asset. Even better, gift money to your adult children so that they can max out their own Roth IRA contributions. They get $7,000 of their own money growing tax-free for decades. Family limited partnerships or LLCs. This is for families with significant wealth or business assets. You create a family limited partnership or LLC, transfer assets into it, then gradually gift partnership interests to your children. The magic, partnerships interests can be valued at a discount, sometimes 30 to 40% below asset value, because they lack control and marketability. This means you can transfer more wealth while staying under gift tax limits. Life insurance. Don't overlook life insurance as an inheritance vehicle. Death benefits are generally income tax-free to beneficiaries, and if structured properly in an irrevocable life insurance trust or an ILET, the death benefit isn't included in your taxable estate. For someone with a $10 million estate who might face estate taxes, a $2 million life insurance policy in an ILET can provide tax-free liquidity to pay estate taxes, protecting other assets. The advantages of lifetime giving. Remove appreciation from the estate. Future growth happens outside your estate. See your impact. You get to watch your kids benefit from your generosity. Annual exclusion strategy. Methodically reducing your estate over time, tax-free. Help when needed most. Your kids might need money more at 30 than at 60 when you die. relationship building. Giving can strengthen family bonds and teach financial responsibility. The disadvantages: there are real risks. Loss of control. Once you give it, it's gone. You can't take it back if you need it or if your kid makes bad choices. No step-up basis. When you gift, your gift appreciates assets during life. Your kid inherits your basis. They'll pay capital gains tax on all appreciation when they sell. If they inherit a death, they get the step-up and pay no capital gains. This is often worth more than estate tax savings. Medicaid look back. If you might need Medicaid for long-term care, gifts within 5 years can disqualify you. Premature wealth transfer. Giving too much too soon can remove your kids' motivation to build their own success. Real life example. David was a successful business owner. Starting when his kids turned 25, he gave them each $18,000 every year. His wife did the same, so each kid got $36,000 annually. Over 15 years, he transferred $1.08 million to his kids without any gift tax. His kids used this money to buy homes, start businesses, and invest. By the time David died at 73, his kids were financially independent and didn't need an inheritance to survive. But David still left them money in a trust because he'd successfully reduced his estate and still wanted to provide for them. So, how do you choose? Here's how to think about it. Use outright inheritance if your kids are financially responsible and mature, your estate is well under federal and state tax exemption limits, you want simplicity and low cost, your kids don't have substance abuse, disability, or creditor issues, your assets have significant appreciation, step-up basis is valuable. Use trusts if your kids are young, immature, or financially irresponsible, you have concerns about divorces, lawsuits, or creditors, you have a child with special needs, you want to control timing and conditions of distributions, you're building multi-generational wealth, your estate might face estate taxes. Use lifetime gifts if you have more wealth than you need. You want to reduce your taxable estate. You want to see your kids benefit during your lifetime. Your kids need help now buying homes, starting businesses. You have assets with high expected future appreciation, the hybrid approach. Here's what sophisticated estate planning often looks like. A combination of all three methods. Example strategy: give $36,000 per year to each child, annual exclusion gifts. Fund 529 plans for grandchildren. At death, leave $200,000 outright to each responsible adult child. Leave $500,000 in trust for the child with substance issues. Leave your business in trust with professional management for all kids to benefit. This approach uses the strengths of each method while minimizing weaknesses. Tax planning considerations. Before you decide, run the numbers with a tax professional. Calculate your potential estate tax. Are you actually going to face estate taxes? Many people overestimate this risk. Compare step-up basis savings versus estate tax savings. Sometimes the step-up basis is worth more than estate tax savings, especially with highly appreciated assets. Consider your state taxes. Your state, estate, or inheritance tax rules might be a deciding factor. Fortunately, here in Georgia, that's not a consideration. Here's what you need to remember. There's no single best way to leave money to your kids. Outright inheritance is simple and provides great tax benefits through step-up basis, but offers no protection or control. Trusts provide incredible control and protection, but are complex and expensive to maintain. Lifetime gifts remove assets from your estate, but you give up the step-up basis and can't get the money back. Most people will benefit from a combination of these strategies, customized to their unique family situation. But here's what I really want you to take away. The biggest mistake isn't choosing the wrong method. The biggest mistake is not planning at all. Without intentional planning, you default to the worst possible option. Intestacy, where state law decides everything. Don't let that happen to your family. Here's what you should do this month. 1. Calculate your net worth. Know where you stand relative to estate tax exemptions. 2. Honestly assess your kids. Are they responsible? Do they have issues that need protection? 3. Schedule a consultation with an estate planning attorney and a tax professional. Don't do this alone. The strategies I've outlined require professional implementation, and most importantly, have conversations with your kids about money, responsibility, and your plans. The best inheritance includes financial education, not just financial assets. If this video helped you think differently about inheritance planning, hit that like button and subscribe for more content that can save you and your family serious money. Drop a comment below. Are you planning to leave your kids money outright, in a trust, or through lifetime gifts? What factors are most important in your decision? Thanks for watching, and I'll see you in the next video.